Blackham Resources has announced a pre-feasibility study relating to the expansion of their Matilda gold project. Overall, this was a strong result for the company as it highlighted the potential for the project to become one of the few gold operations in Australia that will produce more than 200,000 ounces of gold per annum and not owned by a major producer. This has resulted in an increase to our valuation to 97 cents per share. The assumptions we analyse in further detail include our mine life, operating and capital costs, the gold price, as well as our assumed discount rate. Despite it being around 3 months since the release of the expansion study, Blackham has managed to increase the mine life by around 150,000 ounces of gold. Whilst the underground assumptions remain similar, there was a noticeable increase in the open pit material, mainly from the Wiluna open pit area. Importantly, the majority of the mine plan is now classified as reserves, again with the Wiluna open pit accounting for the majority of this, with just under 700,000 ounces of reserves. Over the last 3 months, Blackham has completed a further 20,000 metres of infill and extension drilling in the northern Wiluna open pit resources. This is likely to see further improvements in the project's reserves and mine life when the DFS is released in early 2018. And given the ongoing drill program, as well as there is around 4 million ounces of gold in resource outside of the current mine plan, we believe it is likely the mine life will increase further in the future. To highlight this potential, we completed a range of different mine life assumptions as shown in the graph. There was a significant reduction in the all-in sustaining operating costs compared to the previous study of around $100 per ounce. This was largely due to lower processing costs. This reduction in processing costs is because once mining of the oxide material is completed, the current oxide circuit will commence processing sulfide materials. However, instead of producing doré, it will produce a gold concentrate, which eliminates a number of the back-end processing costs. And whilst gold concentrate is sold at a discount to the spot price, we believe this discount received will largely be cancelled out by the savings in operating costs. Initial capital costs remain similar to previous guidance, however it will be completed in 1 stage rather than 2. We however note Blackham has examined the potential for the development of a filter concentrate facility in comparison to the redevelopment of the BKHRF facility, which is the base case assumption. The filter concentrate facility is essentially the same circuit Blackham will use once mining of the oxide material is completed, and results in a saving of more than $30 million in capital costs. Again, the trade-off for this lower capital cost would be lower revenue. However, as already highlighted, operating costs would also likely fall further if this option was chosen. But unlike the conversion of the oxide circuit, if the filter concentrate option was initially chosen, there is the option in the future for the BKHRF facility to still be refurbished, which would allow for the production of doré. However, as the study is still only at the PFS stage of development, there remains some risk regarding our operating cost assumptions. We therefore ran a number of different scenarios to examine the effect on our valuation. We assumed a gold price of just under $1,700 per ounce over the life of our valuation, which is broadly in line with the current spot price. But as with all commodities, the gold price will likely continue to fluctuate in the future. We therefore examined a range of different gold price scenarios to highlight the change on our valuation. Finally, Australian gold equities have remained relatively strong over the past year, which has seen a number of brokers lower their discount rate for producers to as low as 5%, whilst we note a number of North American brokers use a discount rate for producers of 0%. We have assumed a discount rate of 10% at this time. We will review this assumption once stable production has been achieved for consecutive quarters. However, to highlight the potential change to our valuation, we ran a number of different discount rate assumptions as shown.